Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Geoff, thanks for taking some time to join me on the podcast.
Hey, good to be here, Owen, and please excuse my surroundings. I'm in a hotel room. I'm just arrived in Hobart. I'm down for the Sown Hearts and Minds Investment Conference, which is on in a couple of days' time. So,
well, you look very sharp in your suit, mate. I must admit I am underdressed as per usual, but no, it's my pleasure to have you on the show. We're going to talk about your journey. We're going to talk about the business. We're going to talk about franking credits. We're going to talk about, I guess, even just LICs and the structure of the industry, investment outcomes, and all that sort of stuff. But maybe just to kick things off, I'll start with a few quick fire questions and icebreakers, if you like. And this first question, I have no idea where this is going to go. So I am genuinely curious. Who is the investor that has taught you the most?
Probably the person who would have been also an investor and probably a bit of an entrepreneur was Sir Ian Potter, that set up Potter Partners. And I did work for Potter Partners at one stage, but in terms of how he's developed, various businesses, and in his heyday, he was a very dynamic, probably entrepreneur in I suppose investment space. So,
okay.
In terms of investing, the passion would have come from my father. Even though he was a doctor, but he loved investing, and that was a bit from his father. And then probably my first two bosses at Scottish Amicable, 1980. Started at Scottish Amicable, young 21, 22-year-old, didn't know very much about the market or investing or the logic behind it. And my then boss, Chris Walker and Don Brinkworth, they really gave me a lot of the passion about going out, seeing companies, doing the research, company visits, picking up information, just how important that was, looking at medium and small size companies, and they were focused on industrial companies, and
right.
that's sort of an area that I'm quite passionate about.
Yeah, it's always fascinating to hear that. I should ask that question as, what was your first job out of uni or school? Because it's often that have the most profound impact. But we'll get to your story in just a minute, and the origin story of Wilson. But this next investment could be you could have a financial answer for this. You could have maybe something to do with your personal life, whatever. What's been your best investment?
Best investment, probably marrying my wife.
Good answer.
in terms of her mentoring or advice or guidance, giving me sort of my daughter, or our daughter, which is exceptional. In terms of from a financial perspective, probably investing, or I became a stockbroker. I was a stockbroker, and I actually got a license. I became a member of the stock exchange. And when I became a member of the stock exchange, they'd previously tried to demutualise it and pay everyone back the $25,000 they put in. And I sort of liked the idea of being a part owner of that business. And so I became a member, and then paid my $25,000 and ended up getting, when it demutualised, 166,000 ASX shares, which I knew this question was coming, so I did the calculations, worth sort of $11.2 million now. Now, unfortunately, the 25,000, unfortunately, I sold quite a while ago. So, but it was a very good investment. Yes.
Yeah, that's fantastic. Wow. Okay, I didn't expect you to say that. I mean, both of those answers are superb, and I can appreciate why you said both of them. The final one, and maybe this relates to that second answer there, Geoff, is what's been your hardest investment lesson learned?
Well, I mean, losing money is incredibly painful, and any company that you own, you buy shares in and it goes down, you feel that pain. It's probably I remember, when I was set up Wilson Asset Management 25 years ago, I'm managing money on behalf of shareholders, a lot of shareholders, and then I think probably a couple of years in, one of the companies we owned, and say a portfolio of 70 or 80 companies, but one of them went under, and that is incredibly painful. I mean, you question yourself. I suppose another big frustration, and this wasn't necessarily in this company, but it's when you go and meet management, and sort of these are disappointments, and when they lie to you. And you only find that out in retrospect, and it's only it's like natural standard deviation. There's some people at 5 times at either end of the bell curve. So some exceptionally good people and some exceptionally bad people in any industry. So that's both pain. They're both areas of pain.
Well, I guess you've been doing it long enough, right? I'm sure, we say risk is part and parcel of investing, right? So you're bound to have some war stories over the years, and I really appreciate you sharing that. I realized coming into this conversation, I've followed Wilson for so many years. I think I can remember seeing a photo of you in the AFR back when I was just starting investing, and I started to read everything from there. But I still don't know exactly how the business came into formation. What's the origin story there, Geoff? Why and how and when? I've got so many questions.
So I mean, we've got to go back about 25 odd years. A little bit before that, I was trying to work out what am I going to do with my life. I started off in the funds management area, and then I got into broking as an analyst, and then worked overseas. Then also was back in Australia, sort of at a senior level, running institutional sales. And sort of the question, I had a client, Tim Hughes. He managed money for Reg Grundy, RG Capital. He had a big pool of capital, and he said, "Look, Geoff," at lunch he was saying, "What do you really want to do?" And I said, "I'd probably like to manage some money." And sort of around that time, I'm 64 now, getting close to 65, and this was when I was 39, 40. I had a young daughter who was 4 years of age, and was going to work at sort of 6:37 in the morning, and just thought there's something wrong with this. I should be able to have breakfast with my wife and daughter, and so that sort of led me to think, well, how else can I, what can I do that gives me stimulation, that's exciting, that I'm passionate about, and talking to Tim about it. I sort of said, like, what I was doing was the fur-lined mousetrap. I was making a lot of money, but it was killing me. And he said, "What do you really like doing?" And I said, "Look, I'd love to manage some money." So he said, "Look, we're happy to give you some money to manage." And that was sort of the start of the business. And then I put in all the money I had, which was $500,000, and into a fund, and they matched me, and they ended up putting some more money in over the next sort of 6 months. And really, the whole idea was to be perceived as an institution, because as an individual investor, I could have sat at home and managed the money by myself. You just don't get those accesses. Access to company, access to information. A lot of the free money, with IPOs, placements, blocks of stock at a discount. So I thought, okay, I'll call myself an institution, and that was sort of the start of Wilson Asset Management. It started with $1 million of assets, back on the 1st of January 98.
So this was the inception of WAM Capital, is that correct?
It started off with a trust structure, and it's
Okay.
Wilson Asset Management Equity Fund. And really, it was, really had to prove that even though I managed money back in the early 80s, I was sort of a
Right.
trainee or in funds management. I hadn't managed money publicly before. So it was really the track record of that over 18 months. 18 months into it, then we went and floated WAM Capital, which is the listed investment company. So we still have the Wilson Asset Management Equity Trust. We really haven't marketed it for probably 22 or 23 years.
Right.
We managed some money in there pro bono. We managed some money for the future gen entities, and we managed some money pro bono for the Australian Olympic Committee as well. And we've got I think we've got about another 20 original investors that are in there.
So one of the questions that I got coming through from social media, Geoff, and a lot of the things that I think about too is the difference obviously between trust structures, managed fund structures, and listed investment companies. Why did you decide to go with WAM Capital as a listed investment company?
And pretty much the bulk of the money we manage, the $5 billion on behalf of 130,000 shareholders, the bulk of that is in the listed investment company structure. Even though our initial fund wasn't that structure, and the plan, we will have other funds that won't have that structure. Will be more of a trust structure. But one of the things I loved about the listed investment company structure is I saw a bit of research. This was Morgan Stanley, probably 35 years ago. It was US research, and it showed how the listed investment company structure, or over there it's called the closed-end fund structure. It's a closed-end pool of capital. So whatever money's in there sort of stays in there. So the investment manager can buy or sell shares, never worrying about people taking money out or putting more money in. And it showed that over a 50-year period, it really outperformed an open-ended pool of capital. That's sort of the trust or the managed fund structure by 2 to 2.5% per annum. Now that was phenomenal outperformance. And I thought, geez, so we can create a listed investment company that can trade on the stock market. The structure gives it real advantages where you're just managing that money and you can take a medium long-term view, and you're never a forced buyer at the top of the market or a forced seller at the bottom of the market. And one of the problems with the market is I think the average investor gets about half the market return because they tend to be a buyer at the top of the market, and a seller at the bottom of the market. So money's during the GFC, everyone wants cash, so all the money's flowing out of those managed funds, and that's when they can buy and sell the shares in the listed investment companies, but you're not, as a manager, you're not losing any money. So it gives you a real competitive advantage. And then the other thing, which people say is a weakness for listed investment companies, to me, I think it's like the holy grail. One of the big positives for listed investment companies is you can have $1 of assets and it can trade at $1.10 or it can trade at 90 cents. So if you do a bit of research, then you can get $100 of exposure to the market, and you can only pay $80 for it or $90 for it. So, to me, it was nearly too good to be true. You can have a structure that gives you some real advantages, plus you can buy that below what the value of the assets are worth. So that's pretty much why we went in that direction. And initially, the idea was to have the trust for our wholesale investors and have the listed investment company for our retail investors. But then as it grew, we just continued to focus on growing the listed investment companies. And in terms of, we will add trusts along the way, when it makes sense, I think.
Yeah, would you be surprised if I told you that the median holding period of a fund manager is about 7.4 months?
In terms of how long they own shares, it It wouldn't surprise me. It wouldn't surprise me at all. And of course it'll be, well, in theory they're trying to make money. They're trying to outperform everyone else. So there's obviously a decent amount of performance pressure. And in terms of, depends on your strategies. So like with WAM Capital, our largest listed investment company, half of the money in that is trading, and we would turn over the portfolio 4 times a year, that part. And the other half of the portfolio is sort of undervalued growth companies, and we can only buy them when we can see a catalyst that's going to change the valuation. And like the holding period there can be years, sometimes, if they continue to deliver.
Yeah, I think that's, and the reason why I mentioned that is I think that the open-ended structure of managed funds, and we'll talk about ETFs in just a second, that is I see that from the outside, not someone who manages money, as a significant limitation if you do have a long-term focus, because you're trying to massage the portfolio to try and get it right for the investors. And we expect long-term returns, but we measure monthly returns. And
it is crazy. Yeah. To me, what you're saying is 100% correct. It's pretty crazy.
How about then, Geoff? Obviously, ETFs use that trust structure, open-ended. How have you, I guess, seen the rise of ETFs playing or impacting listed investment companies? And I guess, how do you see that going forward?
Yeah, I actually see it very positive for the listed investment companies. Okay. First of all, you've got to remember the people that manage listed investment companies, particularly like the AFICs and the Argos, they've been around for close to 100 years. And the first listed investment company in the UK, I think it was 1868, foreign and colonial. So the whole structure's been around for a long time, it'll stay, and it'll continue to grow at its rate. The index funds, go back 10, 20 years ago, index funds were the rage, and then now it's ETFs. And like I understand, the ETF has a position in the market, just like listed investment companies. If you want exposure to an index, or to a group of companies, and you want to get in at the value of the assets and get out at the value of the assets, then an ETF's fantastic, a fantastic way of getting cheap exposure. On the listed investment companies, like in Australia, say AFIC and Argo, the two biggest, like their management fees are probably well and truly less than the majority of ETFs. So you're getting an active manager cheaper than an ETF. The positive and the negative you've got there is they can trade at premiums and they can trade at discounts. And like at the moment, the 3 largest LICs, Australian LICs, is AFIC, Argo, and WAM Capital, and they're all trading at 10% plus premiums. So you wouldn't want to buy them at the moment. You're more likely to be a seller at the moment, and you buy them when they're at a discount. But ETFs have a position, and I actually think it's good actually for the listed investment company space, because if you want to, it's nearly the sort of, maybe ETFs are sort of grade 1 in terms of learning investing. In my day, you'd buy a share, and but you're taking an enormous amount of risk, buying a share, because you're putting all your assets into one company. There's no diversification there. An ETF, at least, it gives you exposure to the market, very diverse. And then if you want, then I think if you want to progress, say from junior to senior school, then you start doing research on listed investment companies and work out why they trade at premiums and discounts. And so you're getting exposure to the market at a good price, and then you can get sort of a leverage position. If you're buying at a discount, the market goes up, and then the discount goes from where it was to trade at premium or even at NTA. So to me, it's by doing a bit more research, and then then the next phase would be buying individual stocks. If you want to go that logic.
Oh yeah, I tend to follow a similar train of thought, and we see that in our community. A lot of our newer investors start with ETFs. Makes a lot of sense. by the basket and then explore from there. There is something which I want to talk to briefly, and we've got a lot to talk about. So I just want to touch on these quickly because there was an email thread, and I think it's a shout out to Mark Tobin, who's now got Coffee Microcaps. He put me on an email chain many years ago when I was at the Motley Fool, when the Future Gen products were launching. And I thought it's worthwhile just paying a bit of time just to talk to you about why you decided to launch these products, what they are, and why you felt the need to do them.
Yeah, and hey, good old Mark. The disclose, you disclosed interest at the start. Mark did work with us, so so that's the disclosure of that interest. I suppose when I set up Wilson Asset Management, the whole idea was to have a pool of capital and to effectively make a difference for those people that had the money in that pool of capital. So it was really to make a difference. And as the business has grown, we can sort of make a difference and give back to, the society we operate in and the community we operate in. And probably, when was it, 7, 8, 9 years ago, I was in the UK, and I saw a gentleman who set up, it was called the Battle Against Cancer Investment Trust, Tom Henderson. And I think he's the great-grandson of the gentleman who set up Henderson Asset Management, or he's in the line there somewhere. He was a previous hedge fund manager. And the structure was just a fantastic structure where he'd got a whole lot of fund managers and said, look, manage the money in your main funds for free, and then allow, because you're managing it for free, then I'll direct, say, 1% of the assets to, his focus was the Institute of Cancer Research, and then about another 16 odd charities. And I just thought, what a fantastic structure. So I came back to Australia, and it just took a little bit of time, thinking I'd love to do it in Australia. And we're able to create the 2 future generation investment companies. And we've got the smartest boutique fund managers there. In FGX is the Australian listed investment company. It invests in Australian equities, and FGG invests in global equities. And we've got the smartest fund managers, managing the Australian boutique guys, managing the Australian money, and then the global guys managing the global money. So it's just, to me, take my hat off to all the fund managers. They're doing this pro bono. And they like it because it's an opportunity for them to give back. So, and the great thing is, so $10 to $11 million a year goes to support children at risk in Australia and youth mental health in Australia. So, from those 2 entities, and I think we've given so far about 65 million. So, it is, it's been great. And in terms of personally, like it does, I remember at our 20-year anniversary, I was giving a speech, and I was saying that it actually does give me a lot of. I was one of 6 kids, and so I was the 3rd child. Where does the third child sit? Always try to sort of get mum and dad's approval, probably, but I did take a lot of solace from being able to set up those entities and what it can give back to Australia.
I just think, I mean, there are plenty of people in your circumstance, Geoff, that wouldn't have done it. So that's why I wanted to call it out, because even at the time, I thought it was a fantastic initiative. And credit to you. We just had a look. We're recording this on video, and we just had a look at the website there and could see some of the names that you brought together to do that. I think that's a credit to you for giving that a crack and doing what you've done. And I think when I talk, I often talk to some investors and people who know me personally, and they say, well, when I pass away, I want to create like a charitable trust or something like this where it can continually give money to charities or community groups and that sort of stuff. And to be able to do that in a sustainable way is actually very difficult, whereas this seems to be the happiest medium between everything. So, I just think it's a great initiative, and hopefully we see more of it.
Yeah, and there has been more. Like there's there's the HM1, Hearts and Minds, they've created one. So now, they're giving away nearly as much as we do on an annual basis. So there's and there's room for more. Like if anyone wants, to me, there's room for a property one. I'm happy to help someone. I don't want to drive it. We've got the global one and the Australian one, but there's room for a fixed interest equivalent or a property one. Yeah.
Absolutely. Speaking of, this was just a natural segue to the next thing I wanted to talk to you about, which is the way you think about intergenerational wealth transfer and giving, but not also the financial aspect of giving, but also how you prepare, whether it's family and whether you've seen this with your shareholders or your team, how people can prepare their children or their nieces and nephews, their grandchildren, to be, I guess, worthy with the money, but also just even learn about investing. I think that's just a really important part of it, the education. So how have you approached that challenge? Because a lot of families find that very difficult.
And it is difficult. I think it has to be via conversations. And I know, I suppose I was I know my situation was more curiosity. I saw my father at night after he'd come home from work and have dinner, sit down and read the paper and look down and, at the list of a whole lot of numbers on a page. And I remember asking him, what are all those numbers? And he said, that's the stock market. I thought, that's a weird concept. And then I looked down and there was a company trading at 1 cent, and I thought, I could afford that. It ended up going under. It was Cox Brothers. It was a Melbourne retailer. But anyway, I think it has to be via conversation. And also, I'm a big believer. You asked me, one of the early questions was sort of who, was instrumental in sort of shaping what my view was from an investment perspective. Now, I've always been very curious, and when there's an opportunity presents itself, to me, try to talk to people, that have succeeded and have experience. I don't see it necessarily as having a mentor. That's great. I know it's very modern to talk about that. I don't think I ever had a mentor, but there's people that I respected and looked up to and try to understand why they did various things. And I remember, a long time ago, David Clark, who was the chairman of Macquarie Bank, very successful since the early days of Hill Samuel. I was fortunate enough to meet him a few times, and then I said, look, let's have lunch, and we talked about that. And about 30 odd years ago, again, there was this young lawyer that had done quite a bit, Malcolm Turnbull. I remember when he had a listed company, and when I was broking, we were sort of associated with that a little bit. And so I said, look, Malcolm, can we have lunch just to understand how his mind ticks? And then when I became a member of the stock exchange, then I rang up Morris Newman, who was then chairman, and he probably thought, who is this guy? Out of the blue, I said, look, I've just become a member. I'd like, he's chairman of the ASX. I'd like to have lunch with you. And to me, it's just trying to understand their journeys. I know from a work perspective at Wilson Asset Management, we try to get the smart people involved, with the organisation to give people exposures and experiences. We've got someone at the moment who's first class, Dr. Gemma King. She did a lot of work with the Defence Forces in terms of resilience, things like that. Ben Crow, who was Asparty's coach, and I think did the Richmond football team. Again, I just saw a write-up in the Fin Review of both those, and threw it in the pot at work, and we got in contact with them, and they came in and done some work with us. And Adam Goods, we're supportive of the Go Foundation, and to me, Adam's got incredible wisdom, and to me, it's just trying to get as many exposures to people, and trying to find ways to get those exposures. There's no, I don't think there's any, necessarily secret formula. In terms of investing and what to do with money, it's trying to have as many of the conversations. And some people are interested in it and passionate about it, and some aren't. And if there's assets there and they aren't, and well, they can keep them in cash, but if they want to take some risk, then they've got to work out, do they do it themselves, or do they give it to someone else to try to help them?
I think one of the reasons that our podcasts have been so successful, Geoff, is because sometimes in our culture, when it comes to learning about money and investing, it's almost a taboo subject. You don't talk about how much you earn, how much money you have, all these types of things. And to the point, like George's point earlier on, where you talked about, the demutualization and the ASX shares and all that, a lot of people don't talk about the numbers because for one reason or another, that they just, we're almost, it's ingrained in our culture not to talk about that. And I find that that's a really big problem, not just because we should be talking about it, but because it's also very important. So, it's not like we're talking about fast cars or something like that. We're talking about money. And I find that the families that have conversations around the dinner table about money, the children are oftentimes much more inclined to embrace the idea of investing and feel it's a positive thing rather than a thing to be feared, if that makes sense.
Yeah, no. I mean, that's a very fair point. And that's, it is, one of the sort of frustrations with our schooling system is, probably some of the most important things is, your financial well-being or your health. But we're not really taught much about either of those at school.
Yeah, I can tell you I've never used that much trigonometry since I left my specialist maths class. But I mean, it's great for me because in our business, we have 110,000 people that listen to the podcast, right, Geoff? So for me, it's great because people that don't feel they have the confidence to go and talk about investing or money can come and listen to the podcast and hear conversations like this. But how about, you mentioned your team there, and since I've been following the Wilson story, you've built out that team. You've got some incredible people in the business. Is there the way you think about bringing people into the team, is there like a set structure or things that you have done, like strategies that you have honed over the years to, I guess, increase the chance of success? Because whether you're a big company, a small company, a corporate, this is the challenge, not just now because there's low unemployment, but in general. This is the number one frustration.
I think the first thing you need is to have a values match with the individual.
Okay.
And so what we do is, we've been doing this for probably 20 odd years. Luckily, so 20 years ago, there was a gentleman, Alex Verheer, who did a lot of work with us on our own values and why do we exist and what drives us and why we're passionate about what we're trying to do. And it's really, there, and then you realise, and we've got if you come for an interview with us, then you'll be asked to, out of like 150 words, pick 10 of your personal values, 10 of your your current work values, and 10 of your desired work values, and then we've got. We've done it as an organisation, so we know what our values are, and then initially it's working out whether your values and our values match. And people at various stages, the values sort of triangle that we look at, or is very similar to Maslow's hierarchy of needs. But it goes from the very basic, but then to the very to the most advanced. And so to me, values is incredibly important. And then from my perspective, it's the, sort of the quality of the individual. And you need to try to make an assessment in an interview or in a group of interviews about the quality of the individual. Because, I suppose if we go back to the start of Wilson Asset Management, we were talking about before, it was myself, and there was, I thought I'd just be a sole operator, that running a small pool of capital. And then about 4 months in, another thing I wanted to do was write a book. I had my sort of write a book, go on a couple of boards, have a little pool of capital to manage. And in terms of writing the book, I was talking to Matthew Kidman, who was then at the business editor at Sydney Morning Herald, and said to Matthew, "Hey, look, do you want to ghostwrite a book or we write it together?" He said, "Let's write it together." So I was working with him, and then he said, "Hey, look, he's had enough of being a journalist. He wanted to get into the investment game." So I sort of told him a few people to speak to. Then when he was close to getting a job, I thought, "Oh, geez, I'm writing a book with him. I want him to come and work with me." So, but in terms of with Matthew, even though he hadn't invested before, professionally, like he was a good, high quality individual, and to me, if it's probably a little bit like, maybe it's not like investing or buying horses. With horses, it's the bloodlines they look at. But to me, from my perspective, it's the quality. If you've got a high quality individual, they mightn't have the skill set at that point in time, but they if they're passionate about what they do, then they will get that skill set. And probably the third thing is, it's values, it's the quality of the individual, and the third thing is passion. They really need to have a passion about investing.
Like you said, for you, it was curiosity. One of the very first person who came on this series many years ago said, and is Wayne Peters from the former fund, Peters McGregor. He said the thing that keeps you getting back up on the horse is curiosity. It's just being curious about the world. And I think that rings true with all of the great investors who I've spoken to on the show.
Well, that's the great thing about investing. That's the great thing about investing, isn't it? Because it's so dynamic, and I mean, you've got to be passionate, and because it changes so much, you've got to be curious, and because it's so humbling. Like you think you've worked it out, and bang, like you for a fix.
Yeah, that's true. Yeah, I guess that's the thing to finish first. You first got to finish, and getting to that finish line is quite difficult a lot of the time, because we do, we follow that humility curve. We tend to think we've got it, and then all of a sudden, the market or some extraneous variable comes out of nowhere, and we're humbled yet again.
Definitely.
One of the things that I really wanted to talk to you about, and I know that you're keen to talk about as well, is basically what's transpired with the franking credit system, and in particular, like otherwise known as imputation. And maybe just to set the scene, Geoff, can you give us kind of like the 101 on franking credits? Like I assume everyone listening to this knows, but just in case, I figure we may as well catch them up. And maybe what we can do as part of that framing is what was proposed at the last election versus now.
And why don't we go all the way back? Because Paul and Bob Hawke brought in a system, and what they in the old days is a company would make money. It would, say a company would earn $100 million. It would pay tax, say $30 million. It's the corporate tax rate for large companies at the moment. So it would pay $30 million tax, and it would have $70 million left. Then say if it paid out, it paid out 35 million of that $70 million and kept the other 35 million and invested in the business. Well, that 35 million it paid out as a dividend. In the old days, you get that in your pocket, and then you'd pay your amount of tax. Like if you're on a 30% tax rate, then you lose another 30%. Or if you're on a 48% tax rate, you lose another nearly half of that money. But what Keating said is, like, that's being double taxed. So he said, I'll remove the double taxation. And they called it, in Australia, they called it dividend imputation. They did a similar thing in the UK back in 1977. I just can't remember. The acronym was ACT. It was something corporate tax. Could have been associated corporate tax or something like that. So that was the idea, and that was the principle. And what it did. And with companies, when companies look to expand, they've got a choice. They can either borrow money, and the interest is tax deductible, or they can raise equity. And what the dividend imputation system did, first of all, with Australian companies, it encouraged Australian companies to invest in Australia, to employ Australians, to pay tax in Australia and pay fully franked dividends to the shareholders in Australia, because that supported their share prices and actually made equity cheaper than debt. So Australian companies don't have anywhere near as much debt as European or US or other global companies. And that's why we did so well during the GFC. And that's why we'll do, there's going to be a recession globally in the next period. We could already be in one. So that'll really help Australia now. So to me, what a fantastic system. Now there's arguments. Oh, look, it favours the old people. They get these free kicks. What about us, the young people? We don't. Hey, anyone who's got money in superannuation benefits from the dividend imputation system. As they've got investments. Anyone who is employed by an Australian company, like in theory, it's just like it's invest in Australia and support Australia. That's what dividend imputation does. And the reason we were very active in 2018, 2019, because then Labor, that was in opposition and they were expected to win that election quite easily, they came out with a policy which was just so unfair, where you could have 4 people that were the same age and had the same amount of money, and depending on if they had the money in their self-managed super fund, they lose the franking. If they had their money in an industry fund, they get the franking. If one of them went on to pension before the 28th of March 2018, they got the franking. If you were born a week later and went on to pension a week later, you lost the franking. It was just such an illogical system. I agree with what philosophically people are talking about. You don't want, people shouldn't be rorting the system. Let's have a progressive tax system that treats everyone fairly, like our income tax system. Now, I know there's a lot of talk about people that have got $100 million in super, and another person's got $400 million in super. If they're getting a disproportionate benefit, I think Dick Smith said after the last election, he got $500,000 franking credit refund. Like, they shouldn't get that. Now, I agree with that logic, but do it logically and fairly, and don't destroy. It's sort of like the goose that's been laying the golden egg for Australia. Why haven't we had a recession for the last 30 years? And part of it is to do with dividend imputation, those fully franked dividends. Now, what's happened at the moment, like a month before the budget, the government came out and said, look, what we're going to do is we're going to stop, and this was a Treasury proposition. And to me, the disappointing part is the government, when they were in opposition, they said, both Chalmers and Albanese said that they're not going to bring franking. They're not going to change the franking system or dividend imputation system. They're in office for a short period of time and they're starting to change it. So it is a broken promise, which is disappointing. To me, if you wanted to change it, just don't promise you're not going to change it and get elected on that. Because I think that's one of the reasons they didn't get elected in 2019. Now, what the proposal is that if a company pays a fully franked dividend, and either before they pay a fully franked dividend or after they pay a fully franked dividend, they raise any capital, and if $1 of that capital can be associated with that fully franked dividend, and it could be like a $3 billion fully franked dividend, if $1 of capital is associated with that, then that dividend is not franked. So what it means, and then there was something in the budget, and that, like, the one in the budget doesn't worry me as much, but what both of them doing are weakening the system potentially. And what that first one means is, if you're a company, and I talked about that company example before that made $100 million, and you only paid out $35 million and kept the other $35 million and invested in your business, maybe expanded, made a takeover, and that, you can never pay that other $35 million out without borrowing money. You can't raise capital and pay that out. So what effectively it does, it traps half the franking. And there's $430 billion that's already been trapped. and it looks like about 30 billion a year will be trapped. And what concerns me more is this system is great for Australia. Australians investing in Australia, employing Australians, paying tax in Australia. Is this agenda has not been run by the Labor government. It's been run by the Treasury Department, which doesn't want to pay a cent out. And Paul Keating has warned us for years, beware of Treasury. He says every 7 years they come after franking. And it's only taken them 3.5 years to come after it this time. And what happens is, I talked very early on about the UK system. The UK system got abandoned in 1999. And why is because they took parts of it off, and then eventually they say, oh, look, it's not working properly. So to me, what worries me is it's a great system. Keep it in place. Don't change it. Don't take parts off, because what could happen now if they legislate this, and with a bit of luck, it'll be blocked in the Senate, and we'll work as hard as we can to make sure it is blocked in the Senate, is you'll have a situation in a year or two's time, Labor will say, well, actually, it only gives half the benefit it really did before, and it really doesn't work as it did before. Hey, look, let's get rid of it. And to me, it's sort of that slippery slope. And to me, we just don't want to go in that direction. That's why I'm sort of very passionate about it. In terms of inequality, in terms of repairing the budget, I understand that has to happen. In terms of inequality, people getting big returns, they shouldn't get them. So bring in a system that's fair and equitable. If Labor had proposed a fair and equitable system, back in 2018, they would have been in power in 2019, wouldn't they? The problem is, it's back then it wasn't fair and equitable, and what they're doing now is they're potentially dismantling the franking system, which works so well for Australia.
So, Geoff, in your opinion, you said progressive earlier in that answer. What do you mean? Like, how would that take shape? What would that look like?
Well, effectively, and again, it's piecemeal. Effectively, you've got to take a step back and say, look, what are we trying to achieve? Do we want a system? Effectively, which Paul Keating and Bob Hawke came up with. Do we want a system that removes double taxation and encourages Australian companies to invest in Australia, employ Australians, et cetera, and then, okay, that's where the dividend imputation system turned up. So to me, it's more in terms of me saying, oh, look, you should cap this at this, or you should do, to me, that's all piecemeal. You really need, to take a step back and say, look, okay, we've got to repair the budget. And various things aren't sustainable. So how are we going to restructure things that are fair and equitable, to everyone, by just coming out and saying, oh, look, it is so like, if I had hair, I'd be pulling my hair out. It is so frustrating. With what the Labor government's come out with. Back during the start of COVID, APRA, that regulates the banks, came out and said to the banks, you can't pay a dividend because, when we're all worried about things. And then they came out and said, you can pay a dividend, but they said you can only pay a dividend if you raise capital. So, Westpac paid a $2.8 billion dividend and raised $2.5 billion at the same time. So if that legislation came in, then that would have been unfranked. And effectively, what APRA is telling the banking system to do was raise capital to pay your dividends, but if you raise $1 of capital to pay a dividend, that's not franked. To me, it's just so illogical, which frustrates me, as you can see.
Do you think there's a better way to manage then the capital raising issue?
To me, they just shouldn't. They just should leave that alone. To me, it's the issue in the budget. The buybacks. Again, that's not to me, it's just chipping away at the system. it's not a real breaker of the system. To me, what they're doing is effectively what they're saying is the only way you can pay out they're saying you as an Australian company, you earn $100 million, you pay $30 million tax, don't invest in Australia, don't invest in the business, pay that $70 million just to your shareholders, because we're not going to let you raise any capital associated with paying out any of that dividend, or or pay out 35 million as a fully franked dividend. The other 35 million invest in Australia, invest in the business, but you're never going to be able to pay that out unless you borrow money. And companies they run, you're trying to maximize the return for the investors. So you won't want to all of a sudden gear up just to pay dividends. Then boards won't do that. So that unfortunately that franking will be lost forever.
I'm just going to throw some things out, Geoff, and just you respond as you will.
Right.
What would you say? So from an investment perspective, some investors they compare our market to the United States, where you have these wonderful technology companies, and we have wonderful technology companies too, but they're obviously, mega companies, right? Global names. What would you say to the argument that by overly encouraging our companies to pay dividends, that has an impact on innovation?
To me, that's a pretty long bow, because you think of, you cast your mind back to innovation in Australia and the pools of capital that would support innovation in Australia. Like a decade ago, there was virtually no capital. And now the sector is there's billions of dollars of capital, to support Australian innovation. And to me, it's more that leadership thing where you see Australians perform domestically and globally, like the likes of Atlassian and companies like that. Then people realise that there's there are smarts here, and we'll invest in it. To me, whether it's frank dividends or not, to me that hasn't. I don't think it's much of an impact. But keep hitting me with the questions.
Yeah, it's interesting, a lot of the stats that you had before. I spoke to Fidelity, I think it was Paul Taylor, and exceptional fund manager, going for a long time. And he said one of the three reasons that the Australian stock market has outperformed basically every stock market in the world is because of our ability to pay dividends. And that stable democracy with dividends being paid is actually a pillar of the stock market's return. And in preparation for this chat, Geoff, I pulled up the 10-year return. So just 10 years, it's a decade. It's not that long in the scheme of things. And I looked at the returns of the ASX 200, just in terms of the share price and capital gains, up 5.1% per annum. Dividends, so total return, 9.5%. And if you adjusted for franking credits in a super fund, 10.15. So that's 60 basis points per annum. To me, probably isn't as big as I thought it would be, to be honest. It kind of goes to show the dividends are still powerful, the most powerful component.
Yeah, that's right. And that's right. And like the dividends, that they're not 100% franked, because some companies do pay unfranked dividends. But and I remember years ago when there was a good debate about franking, and we all put our submissions into Treasury or into the government, and Fidelity put a very good submission in it as well. And they were basically saying, and I think we might have used some of the research they had used, which showed that really companies that pay out high dividend payers over time do better. And the logic behind there is if you've got exceptional management and you leave excess capital for that exceptional management, then they perform well. The problem is, not all management is exceptional, and if you leave excess capital in with management, sometimes that excess capital gets squandered. It doesn't get invested that wisely. So, and I think a lot of studies have shown that companies with higher payout ratios over time outperform companies with lower payout ratios, which is interesting. And obviously there's all, while I'm saying that, I'm thinking, well, hold it. When you got a tech boom, companies don't pay anything, so that they would be significantly outperforming. It depends. It's probably when you took the data, but broadly industrial companies, like the boring industrial companies, to me, you're better off giving the money to shareholders and let the shareholder decide how he wants to allocate the capital.
How about? Sorry, go on.
Then there's the Buffett argument. Well, hey, you shouldn't pay anything out. Just if you're good, just keep reinvesting in the business. And I suppose that's the thing. If the companies are exceptional, then don't pay it out. Keep reinvesting in the business. But to me, to get exceptional returns on equity, it's not every company. So unfortunately, there's only a small number that can do that.
I think one of the issues with the franking credits debate is that it's quite complicated from a policy perspective. Like a lot of people simply don't get it. They simply think money seems to be going to investors that could be used to pay for insert climate change, hospitals.
Yep.
That I feel like that's my personal opinion. I'll try and keep that out of it. It's too simplistic. But how do you think about that? Like we could repair the budget from franking credits.
Yeah, I mean, that's 100% right. And that's what Labor tried in 2018, 2019, but it actually failed because that's what they broadly said. They said, the bizarre thing is they said, look, it's good to have a diversified portfolio. Invest globally. Don't invest in Australia. We're going to get rid of the franking. You're a self-managed super fund. We're going to force you to invest globally because we're going to take the franking away from you in Australia, unless you're on a pension. So to me, it is like, to me, some of the comments are a bit crazy.
How about then, Geoff, and you kind of touched on this before, another, I guess, point or perspective is that franking credits, and you mentioned inequality earlier on, franking credits tend to accrue to wealthy investors.
Well, it's more the wealthy investor, and this is where, to me, this part of the system. Don't stop the company from paying a fully franked dividend, because I know the logic is it accrues to the wealthy investor. It actually accrues a significant amount of it accrues to the mum and dad investors that have sort of worked all their life, put enough money in their self-managed super fund, haven't gone to the government for a pension, and trying to work through their life. It's actually the people that are paying less than the 30% tax. It's the low income earners, because they get the money back. If you're on a 48% tax rate and you get a fully franked dividend, you got to top up. You got to pay another 18%. So it's not I personally don't like fully franked dividends. Me getting any myself, because I just got to pay more tax. So to me, it's really those people that are getting that have the big super funds that are getting those, like Dick Smith, getting those franking credit refunds. And that's the bit that has to be, that's the bit of the puzzle that has to be solved. How you solve that is you don't take it away from everyone. So there's like, when back in 18 and 19, like some of the stories that were sent into us, like they would make you cry, in terms of people, that have worked all their life, done the right thing. I remember this gentleman in Canberra. He was he was a senior trade union person. Was retired, then drove trucks for a while, then had a back problem, was on a disability pension, never went on the government pension, saved up enough to have a self-managed super fund. Was living on the, I think on whatever it was, 30 grand a year, or it was a combination of dividends and franking. And then the government, bang, was going to be his income was going to be chopped by 35%. So to me, it's sort of trying to find a way that that doesn't destabilize everyone. Work on the, as I was saying before, progressive. Like focus on the people that have that are getting too much. Like the tax system. Like why can't there be a progressive situation where if you're getting a small amount of franking credits back and you're on a low income, then you get the full benefit. But don't stop the companies from paying it. Like, unfortunately, back in 2019, they tried to stop the individuals from getting the franking, and now Labor's trying to stop the companies from paying the franking. So to me, they're trying to think they're smart, but unfortunately, like it's playing around with a system that has worked very well. Just take out those unfair excesses where the people that shouldn't be getting the big returns, take them out. That's what they've got to do.
Yeah, I really appreciate you taking some time to step us through that, Geoff, because there are so many perspectives. We only just covered a few of them, but I know how valuable it is, not just to investors, but even people in retail super funds and the like. Basically everyone in Australia would receive, every working person in Australia would receive a franking credit in one form or another. So it is.
If you're a 19-year-old and you started working, then you benefit from the franking system, because you're getting, you got money in super, but also in terms of your employer or your employee.
One of our most popular web pages of all time, Geoff, is franking credits calculator. Just trying to help people figure out what they get, and our video on franking credits is also the second most popular of all time, despite all of these conversations that I have. Those are the most popular. I'll put a link in the show notes. You've done a few write-ups. You had an opinion piece in the AFR, so I'll put a link to that as well, to the Wilson site and all the funds there. If you are listening to this or watching this and you want to learn more about how Geoff and his team invest, I think go to those monthly reports, get the commentary. I'll put the links in the show notes, mate. But I've got one final question, and this is I find this is a very difficult one. So, but I also think that it brings up some great responses. So it's what's something that you believe about life, business, investing, what have you, whatever, that few people would agree with you on?
Good question, as always, Owen. I actually think it's probably anything is possible, and I think a lot of people would say, "Oh, look, they agree with what I'm saying," but I actually don't think they are. Like my father probably instilled it, I think, in us, as children, that really, anything you want to do is possible. To me, if everyone sort of believed that was the case, then they'd be doing what they're passionate about. And I think there's a lot of people out there that probably, unfortunately, aren't doing what they're passionate about. So yeah, to me, it's that's it. Yeah, like it's anything is possible.
I think that's, people would agree with you in principle, but then think. Great response, Geoff. And I just want to say thanks. I know you're down in Tassie for the SOAN conference, and I just appreciate you taking the time to join me on the show.
Yeah, and Owen, if you think anything is possible, then it is.